welcome to the Pump and Dump channel for another video. This is probably going to be the last one on this topic of the theoretical model portfolio. Main reason why I've decided to discontinue it is that obviously nobody seems really interested in it. There's like one view, two views, no views. Not even for the 4-year performance, nobody seemed to care. So decided that this is obviously not what people want to see. They obviously are more interested in me talking about a specific name. As you can see here, there's every time there's a company name in it, it gets like 20-30 times as many views as anything relating to a theoretical model portfolio. No one seems to care, as I mentioned, so I'll just bring this to a conclusion, since it's a lot of work of doing these videos and kind of just dragging along and thinking through how to best allocate it based upon the overall exposure, because you have to make a decision here at the end of the day, and it's not like during the day when you can just trade it efficiently. So yeah, I've done this here. I just summed up the performance for a quarter, basically from mid-year to September. It wasn't very good. There's some reasons for that. I'll go through why. Number one, here with African Gold Group, it's the project is progressing, but the way the management is going about it is not necessarily value accretive for existing shareholders. They keep diluting at fire sales prices to advance the project, and yeah, it's just it's not very efficient how they're handling it. And even if they do manage to increase the value of the project, it doesn't seem like it's going to benefit the shareholders at this point in time, because construction's way off. Next thing to talk about, PBF Energy. Here I think I made a mistake of thinking it could rise, continue to rise. I had not paid enough attention to the RIN situation, the renewable identification numbers, whatever certificate it's called. They had been rising in the first half of the year, and obviously that had an impact on not only the projected cash flows that they would be generating from their operations, but also their liabilities, since they don't settle them as they sell the refined product into the market. But the positive sign here is that the RINs situation seems to have improved. The RINs prices went down substantially a few weeks ago, and that should obviously have a positive impact on the balance sheet, unless they covered at the high prices, because of sometimes you have to buy at the high because you're overextended, and you kind of feel like you have to do it, and then you make a silly move, even though it's in retrospect you feel like a dummy for doing it. So yeah, this is the situation. So I still think there's a potential double from where it's at, but we will have to see how things progress. There's a lot of bad news around the company in terms of the California, what's it called, the regulatory body for the air pollution, or whatever it's called. They want them to put in a wet scrubber for $500 million, and that's obviously not something they want to do. They want to come up with an alternative solution, which is not going to be as efficient, and probably for that reason it will be it won't be accepted, because regulators can't just say one company can do it this way, another company has to do it that way. It's it's like a one-size-fits-all type of regulatory environment. So yeah, PBF Energy is a bit in the tank from where it had been just 6 months ago. Next one here, Safe Bulkers. Safe Bulkers is doing okay. The rates for dry bulk shipping are still very very attractive. There's obviously some bottlenecks that have formed over time, and this will link into other companies. I think the way I should talk about it is here the supply disruption. The idea of supply disruptions has led to inventories building up, and of course, as inventories build up, subsequently when they all can find a taker, an off taker for their product. They all want to ship it, so they all are willing to pay top dollar to get their goods out, and that's why the shipping rates probably are where they are at now, because everyone wants to get rid of it right now, especially since prices have been pushed higher in the futures market. So yeah, the shipping rates are benefiting. Safe Bulkers is doing well. It's reached what it has as a 3-year target already. Today it went above that, but here it's a question of, you know, what will the company be able to do in this phase where shipping rates are extremely high. The charters especially are very high. If they manage to get a lot of their vessels onto the higher prices, then it's good. If they don't manage to get a lot of them onto the higher charters, it's not going to benefit them, this situation that we have right now. So that of course also applies to Diana Shipping, which has also done very well. I think this one could go higher, but to be quite frank, based upon amortized costs for the vessels, the two companies are priced fairly here. It's anyone's guess whether the market wants to keep pushing them or not, but we will see. Next we'll get here to CNX Resources, which has not done very well. I expected more from them, but here it's a matter of their strategy. They don't want to bring on additional production, which they could do probably, and it would be value accretive for shareholders, a lot more value accretive than what they are doing right now, which is just fulfilling their contracts and doing this financial engineering, was taking on debt at a lower interest rate than the discount rate, and yeah, the other things they are doing is just not it's not very efficient. So here it's a case of you know, hoping that the natural gas price, you know, eventually turns and goes down, because then even, you know, even if the stock is at like 12 now, it probably would fall with the natural gas price initially, until people recognize that they have the strategy that is appropriate for a falling natural gas price, and then it would probably rebound and start moving higher. And right now, like, I would say it's worth about $20 a share, but it could go back to 10, and from 10 just to 15. It really depends on how the situation evolves. I can just bring up the natural gas chart. You can see here we had this big move here from 370 all the way up to 560, which is incidentally 10% above the 2018 high. And a 10% move above the high is usually what I would see here as a topping, because we have the same situation in gold. If I just bring up the chart, we can go back here to 2011. We can see at 1900 was about the top, and then eventually it got to 2100, which is like a 10% move above, and then it faded down towards the prior high just below, and then eventually folded, and then just came back up one more time before, you know, going down again, and it looks like it's going to roll over, in my opinion. So getting back to natural gas, here I think we could drop here back to somewhere here. In the coming days, you never know how long these things take, and then eventually we might, you know, come back and make a double top, and then from there we could eventually just fall down to here, back to 4, you know, do a zigzag back down towards this line here, somewhere around 330 or so. And yeah, that would seem reasonable. I mean, I've looked at quite a lot of companies, and they can, for the most part, their all-in costs are below $3 an MCF. Many of them, well, not many of them, but quite a number of the ones I've looked at are under 250 all in. So there is no reason why we need to have $5 natural gas in the near term. You can say it's the supply shortage or the inventory inventory shortage. And if I just look at, let me think, where was it? The natural gas storage report. Where they kind of like just give you a list of what is in the tanks and compared to a year ago and to the prior month. You can see here, it's rising. It usually does that from like March to September or so. It starts rising. It's the injection season, and then as you get into September, towards November, the withdrawal season starts, and then it starts going down. So as the inventory starts going down, the price starts, rising initially to suggest that now we've changed the mode from building to withdrawing. And of course that's kind of like, the beginning is obviously when people start thinking we'll need natural gas, so they're willing to pay top dollar, which is around this period right now. And then that leads to obviously the price then going along with how the withdrawals are happening. If the withdrawals are consistent, in line with expectations, then the price will probably just fizzle down, normally. But if then there's a week where there's a blizzard, it will shoot up, and then after that it will fade again, and eventually we'll get into March, April, and then we'll start bringing in new, injecting new volumes into the system, and then it cycles kind of like that. So yeah, the broader theme, however, I think is maybe around the natural gas liquids, because I think I listened to quite a few conference calls in the past few weeks, and they all talked about the propane shortages, and natural gas liquids, they come with natural gas and oil. So for an E&P company to feel justified in going exploring and increasing production of natural gas liquids, it's not like they target what they're looking for. They have to just drill and hope they find it, and the one who finds, of course, what the market is looking for gets the prize. So I think here natural gas and oil prices have been increased alongside the natural gas liquids, because that's kind of where the real shortage is. And in that case, natural gas is probably overstretched at this point in time. So yeah, that's kind of how it is. Next one, Petrobras here. I saw they were sending a new ship, not a new ship, but an additional ship, let's call it, to one of their oil fields. So that's kind of suggesting they're planning to bring on more production. They paid out some dividends in the quarter. Marked it here, 62 cents, and PetroChina also has declared $2.01 of dividends. So these two companies are just doing that, paying out the money that they're making. That large percentage of the cash flow is going out to the shareholders, which is the shareholder friendly policy. And PetroChina also, in the conference call, they mentioned that they had made new discoveries in Chad and other places, so they expect their proven reserves to rise for the next year. So that will obviously be a benefit. They'll have more reserves. Their refining arms are doing good. And yeah, everything's good with PetroChina, even though it's gone to 50 before the dividend, and now it kind of almost got back to 50. So you could say there's been a double top there on the chart, and it probably will retrace a bit more before hopefully moving up towards the 60s and 70s. But we don't know yet, of course, because we're not there yet. And Diana Shipping, I mentioned, Silvercut Metals is unfortunately just like Lundin Mining, um, one of these cases where the projected cash flows are just not matching with the income statements, the reporting of the company. They are not mining as much and generating therefore as much cash flow as they had projected. So here it's a clear case of these two. The assets are impaired, which is unfortunate, but I noticed this a few weeks ago, no, actually a month, probably maybe a bit more than a month ago. I noticed this, especially when I was listening to the conference call of Lundin Mining. And it didn't make sense how they, their reserves are the same, but their milling, or their, yeah, I think they said their milling was the problem, the processing part, and the grades were not kind of reconciling to what they were expecting. So here's there's a problem, and that's why it's crumbling, even though the copper price has been swinging between like 420 and 440 for the most part of the quarter. This stock keeps going down because the assets are impaired, and with Silvercut Metals, that is also part of the story. But yeah, that's unfortunately just the way it is. Century Aluminum here. Main problem with them is they are going along with the narrative of the time, which is the supply shortages. They say they can't get all the materials to get their additional part line up and running, and they're also saying that they can't find the people to hire. So they're also kind of like mentioning that they think people are staying at home because the government is paying them instead of getting to work or taking these jobs, so they can't hire people. And therefore the market is punishing them and saying, you know what, you guys, you said you're going to increase production by year end, and or even earlier, and you haven't done so. So they're kind of being punished. And even if you strip out the additional capacity, the stock is still undervalued, but doesn't seem to matter. There's also the problem that the iron ore price has fallen, of course, as the past months of futures have expired, where the prices were extremely high in the 230 or maybe even higher than 230 a ton, and they've gone down by like 50%. And of course that was expected because the backwardation was quite extreme, and that's of course also the situation in natural gas right now, where the backwardation is quite extended. And also, like, because iron ore is in a way a substitute for aluminum and vice versa, that why would you buy aluminum if you can buy steel? So that's obviously something to keep in mind here, that the market has shifted, and stock is, I mean, it's near what I paid for. It's been at 15 before the quarterly report, where the bad news broke. And yeah, it's going sideways here. So here I'm just waiting because I see the aluminum price is still pushing higher and higher. So I'm just here hoping that the market will push it towards fair value, which is a minimum of 16. Next one, Cabot Oil and Gas, is the same situation as mentioned with CNX. The natural gas price has peaked. In my opinion, it's peaked for this cycle, and they got to $20 yesterday. I was lucky to sell into the strength a little bit yesterday, and then today on the open I sold more than half my position because I can see that it's topping. I've reviewed the Cimarex acquisition, and I've come to the conclusion that it is similar to the acquisition that Lundin Mining made of the Chapada mine, and I'm starting to wonder whether this, also looking like at EQT, it's the same topic. I'm wondering if the company is trying to is trying to divert from what it is doing right now into something different. Because like with Lundin Mining, the Chapada mine is a problem. If it's not just because the country is talking about putting on insane taxes. It's also the production is not meeting the guidance. The technical report is not in line with the quarterly report on the income statement production. So Lundin Mining back in, I think it was 2019, they bought the Chapada mine. They overpaid, and it might have been that they were trying to distract from a failing operation by moving into a new operation, winding down the other one, trying to generate the growth in a new one. And if the same problem applies here with Cab Oil and Gas, where some factor in the macro analysis is not favorable, that they are looking to get something else, or they're just growing for the purpose of growing, that could be a problem. But with Cimarex, the way I see it, I think they overpaid for the merger of equals, valuing the two companies as the same. But in terms of a financial way of looking at things, it can make sense if they get a better valuation as a large entity. I think that is still a possibility, but it is not a guarantee. So yeah, here it is a bit questionable. And with EQT, EQT, I was analyzing it. Well, I've analyzed it several times, obviously, but I was like revisiting it back in August. It was near the low. It was a few days after the low. I was revisiting it. Let me just check. Yeah, it must have been like on the 23rd of August. I started building a position in it, and it ran up to like 21 or so, and then it came back down today and yesterday. So I've diverted some funds out of Cabo Oil and Gas into EQT, because I think there are several things that are not priced in. The Alta acquisitions, Alta resource acquisition is not properly priced in. They got some midstream assets and some low cost oil and gas production that they are going to be bringing onto their production profile, hopefully soon enough that the market will be surprised by it. And even stripping out that, just valuing it against the forward strip, I get like a $30+ valuation for EQT. And that's also taking into consideration that not most, but a lot of the production for the Q3 and Q4 have been hedged away. So the fact that the natural gas prices have been moving up is not that much of an impact on their projected cash flows. So when the natural gas price comes back down, it also won't be that much of an impact. So EQT, the way I've looked at it, it looks better than Cab Oil and Gas, but maybe in the short term that the market is excited about the finalization of the merger between Cabot and Cimarex, so that might still keep rising, but I don't want to take any chances. I'm hopeful that in the next quarters or so that EQT will just pop, because it's way undervalued, and it's the biggest natural gas producer in the US. So yeah, and I've also I think maybe I mentioned this previously on my channel, but I had listened to the CEO Toby Rice in the past, and I thought he was a dimwit, but I did some more research on him, and I kind of see what he's about. He's he's like someone who's not grown up in the industry with the expertise, but still managed to succeed with Rice Energy, and having that being acquired by EQT and then himself taking over. Um, so I kind of see where he's coming from, and he does say a lot of the things that make sense to me, like looking at improving efficiencies, and not just finding small efficiencies that will benefit new projects, but also applying them to the existing operations. So I kind of am in a way confident that with the stock being undervalued where it is now, that you know in the future, as prices normalize, that will kind of like help. It will help. All the things that I mentioned will help get the stock closer towards its intrinsic value. Yeah, I think that's covered all of the names. So see where we are at. Largest positions still PBF and Diana Shipping. Yeah, I think I'm not going to do it, but because I'm stopping this series. But I think the correct call here is to reduce some Diana Shipping and some safe bulkers and putting into EQT Corp. And also, yeah, I saw Range Resources was above $20 yesterday, and I kind of was gutted that I didn't have it in the theoretical model portfolio anymore, because there was a clear turning point not so long ago, and when it fell to 12, there was a turning point in the valuation, diverging from reality a lot, with the fundamentals still being bullish. So into that drawdown, there was an opportunity to get back in. Yeah, Lundin Mining and Silvercorp Metals impaired, not good. Oh well, I mean, sometimes you gotta lose to win, right? So I mean, it's down considerably, 25% and 30%. I think here the correct call is to do what I did, is reduce the positions. I kind of noticed, like I mentioned, that Lundin Mining was not rebounding with the copper price and not reflecting the intrinsic value. It was clearly diverging from the model, which was a sell sign. So I reduced my exposure by, what was it, 80%, and took an L on it, on this trade. With Silvercorp Metals, it's yeah, I mentioned this in the previous videos. I sold when it was in the sixes. I sold a lot of it and put it into Lundin Mining. So I kind of avoided the losses in Silvercorp and traded it for lesser loss in Lundin Mining, which is of course a win in some way. The place where I'm obviously not pleased with myself was PBF Energy, because I didn't pay attention to the RINs, and the RINs is obviously a key component that impacts the balance sheet and also the margins. So that is something I need to get right next time that I see a great opportunity in refining stocks. I'm looking at the RINs as well, not just the crack spread. So yeah, a disappointing quarter here, due to buying two impaired asset companies and not making the videos to sell them. Being not on the right side of PBF Energy as it topped. I did sell. Did sell some at 16 to buy PetroChina, but it should have all gone when the RINs started rising, because they'd started rising in like March, April, pretty strongly, and that was kind of a clear signal that it was going downhill. Should have sold everything there. Also, one thing here was Diamondback. This is also a company where the assets are impaired because of the lower production profile. The stock is still in the 80s. It should be at 100 like it was, or around 100, let's say, as it was a few months ago when it peaked. Since then, it's been trading, not trading according to the model. It's been drifting off just like Lundin Mining has. I remember making the videos about me getting short with put options, and I got destroyed on the put options. Very unfortunate, but I was clearly wrong to be betting on it at that point in time. Yeah, that's unfortunately the way it is. You don't get everything right, but I think that when things make sense and you go for it, it's just important to remember that, you know, when things are going well, that you should sell at some point, or at least take some money off the table, because you never know when it will turn. But sometimes even when the signal comes that it's about to turn or it's peaked, you sometimes want to ignore it, and that's obviously a mistake, you know, because you're looking at the current quarter and you say, okay, well, I mean, it could drop 30%, but I still think in the next 2 years it will go up 300%, so you don't want to sell it, which is the wrong thing to do, because no one can predict the future. And if you look at the futures prices, you can see technical signals. You can see the wedges. You know, when it gets to a conclusion, does it break down? Does it go up? Does it go down from there? The futures are pretty clear most of the time. Wedge here, flag here. Once you break out there, you know, from the flag, you don't know whether it's going to go to 5 or so, or whether it's just going to go back to the high. But you know, you have also the RSI as an indicator. You also have the overall fundamentals as an indicator. Like last year, not enough refined product was processed, and of course they were waiting for the price signals to start, you know, telling them to start producing more again before they ramped up production. So yeah, I mean, here you can see quite clearly that you know, that there is a channel. I mean, there was a channel here where we peaked above and then came back in. Eventually we pushed up again against the channel, stayed around the channel line, and then we moved higher after these patterns. And yeah, then we get to this line, which is 10% above this line, and think, you know, like, I think you don't always have certainty, but sometimes when you look at things, it does seem apparent that this is how it must be. And you know, whether it's like this in a straight line down, or whether it fades and only comes down to, you know, to here on $4, nobody really knows how it will get there. But you know, if you're thinking logically that cash costs are $1, $1.50, $2 in worst case, and then, you know, all-in costs are $2.50, $3 an MCF, then it's, you know, it's nothing you should you know, you should be surprised about, you know, after it's gone up here, that it will come down. So yeah, it's going to conclude the video. As always, not investment advice, not recommendations to buy or sell, just my thoughts, and a signing off video for the meantime. So have a good day.